Welcome back. This is Investor Forever here, and this is week 6. And I'm going to start this episode with the thing that changed everything for me mentally this week. So, my brokerage account paid this month's mortgage payment. Not a traditional bank account, but with my Fidelity brokerage account. Same account where JP Morgan is paying me dividends. The same account where my S&P holdings are compounding. The same account I opened 6 weeks ago with the intention of eventually having it cover my life expenses. Yeah, that account. It covered my mortgage. Now, before I let that land too hard, I know that sounded very clickbaity. I want to be clear about what's actually happening mechanically because it wasn't paid with dividend income, but I'm using margin, and there's an interesting distinction between those two things that I want to explain today. But first, so the payment happened and it made me want to go harder just seeing it go poof like that. Like, if you know me personally, I've been a full-time entrepreneur for a little over a year now. So every dollar that I've made has came from hard labor, not punching into a 9 to 5 job. So with that being said, this week I'm bringing options trading back into the picture. And I want to show you exactly how I'm using it, not to gamble, but to generate additional income and to protect the portfolio at the same time. So last year, options trading saved me when I was let go of my job when I unfortunately had to liquidate my portfolio to pay my bills. So I got hurt on the job and didn't have any other income coming in, and I was pretty much down to my last. What clicked for me this week, because I think this is the clearest I've articulated this strategy since I started this channel. So in crypto, they have what's called stable coins. You got USDT, USDC. Those are assets that hold their value at $1 no matter what the market does. So their whole purpose is stability. They're not there to make you rich. They're there to hold value while you do things with them. And that's how I'm starting to think about the core of this portfolio, because SPACs is an ultra stable cash equivalent designed to protect your principal while it's holding its value. While in contrast, JEPI and SPYI are high yield equity based covered call ETFs. While they generate excellent income, or at scale, their prices fluctuate with the broader stock market and they're not stable in the traditional sense. So SPACs is like my stable coin layer. It sits there, doesn't move dramatically, while JEPI and SPYI pay me every month. With this setup that I'm building, the margin I borrow against them is reliably available for the most part. So here's the actual mechanics of what happened with the mortgage. So the money is in the account in the form of ETF shares, and those shares have value. Fidelity lets me borrow against the value at a fraction of what it would cost to finance anything else. So I borrowed against the portfolio to pay the mortgage. And my next income deposit, whether it be Spark, BPOs, whatever it comes in, pays that margin back down, and the ETF shares never move. The dividend keeps accruing and the drip keeps running automatic. So the margin balance existed for all of a few days. The interest cost on this was pretty negligible at this point, and my mortgage eventually got paid. Now, there was a bit of a delay because I had to add a new payment inside of my mortgage company's portal, but next month should be smooth as butter. That's pretty much it in one real world example. So the portfolio, it holds its value. The margin is there to cover expenses, and the income refills that margin, and the dividend grows the portfolio, and the cycle just repeats itself. And paying that mortgage really made me realize that the ceiling on this is wherever I set it. So before I get into the options part of this, I want to mention something that happened in June of this year, 2026, that a lot of you may or may not know about. So the SEC approved a change in the pattern day trading rule. So for years, if you wanted to actively day trade, meaning make more than 3 trades in a 5-day period, you needed a minimum of $25,000 in your account. And that rule kept millions and millions of people with smaller accounts locked out of active trading strategies. Some for good reasons, because a lot of people don't know how to trade. So it was there to protect people, but at the same time, it was very limiting on the people that did know but didn't have access to those types of funds. So that minimum has dropped to $2,000. And as of right now, you see I'm a little bit shy of $2,000. I'm about to put some more money in here. But after I do that, my account will qualify and your account will qualify if you have $2,000. So that's a meaningful change for anyone who's been sitting on the sidelines thinking options and active trading wasn't available for them at this level. So the door is now open. and I want to use it strategically and not recklessly. Let's talk about options because this is where I want to be really clear about my approach because the word option scares some people and it attracts the wrong kind of energy from others. So I'm not using this to gamble or get rich quick. I'm using options to generate additional monthly income to protect my portfolio when the market gets volatile. Those are two different use cases that I'm going to break both of them down in this video. So the strategy I'm trading is the open range breakout. So the first 5 minutes of the New York market open, which is at 9:30 to 9:35, that's the opening range. So whatever high and low price forms in that 5 minute candle becomes my zone. So I don't touch anything during those 5 minutes. I just watch, maybe drink some coffee, twiddle my thumbs, wait till 9:35, mark out those two levels on the chart, and I wait. So if price breaks above the open range high and comes back into to retest that level, that retest is my entry. I'm going long. If the price breaks below that open range low and retest, I'm going short. So I'm targeting at least a 2R multiple, meaning if my stop loss is $50 of risk, my target at minimum is $100 of reward. So the retest is the key. Anyone can chase a breakout, but the discipline is waiting for price to come back to that level, confirming that it's holding. And then you enter with a defined stop directly behind the zone. This is a clean rule-based system that I use to grow my Webull account as well as pass multiple prop firm challenges back in 2024. So use case number 2 is portfolio protection. This one is less sexy, but it's equally important. So when the market gets volatile and you see big red days, news events, earning weeks, things like that, put options protects the value of my ETF positions. A put option gains value when the market drops. So the opposite of buying is basically a sell position. So when JEPI or SPYI pulls back temporarily, put hedge partially offsets that unrealized loss. So think of it like insurance. You pay a small premium, and if nothing bad happens, you just lost the premium. But if something bad happens, the payout protects what you built. And on a portfolio that I'm actively growing, that protection really matters. So use case number 3. This is a different strategy, the daily high and low. So beyond the opening range, I also trade the previous day's high and low, which is same concept. You just mark the prior day's high, you mark the prior day's low. You wait for price to break one of those levels and retest it. And then you enter in the direction of the break, targeting the next significant point of interest on the chart, whether that be a major support or resistance level or a previous high or a key moving average, something to that effect. So the logic is simple. Those levels matter to institutions. And when price breaks and retests the level that institutional traders are watching, you're trading alongside them rather than against them. And that's the edge. If you can't beat them, join them. So here's how options income is going to feed the portfolio. So this is the connection that makes this relevant to the overall investor forever strategy, as we're going to call it. Options trades generate cash. So when I close a winning trade, whether that's a call on an open range breakout, long, or put on a downside break, that cash lands in my account immediately. So that cash goes directly into the portfolio, which means options income is another input to the system. It buys more JEPI, more SPYI, more SPACs, and other ETFs and stocks as its portfolio grows. It accelerates the compounding, and it also increases the monthly dividend income, and it pays down the margin faster. So I'm not doing this instead of the ETF income strategy. I'm doing this in addition to. And the ETFs are the foundation. They're stable, consistent, compounding daily. They all serve their purposes. Now, the options trading is the turbo or the supercharger in this situation, acting as a variable. So it's active, but potentially significant on a good week. And I'm not worried about the bad weeks. Like if I have a losing day or a week in options, because the losses are fixed into the strategy. So at a 2R risk to reward, even at 40 to 50% win rate, I'll still be profitable. And that's what I had to learn in the past. Plus, the ETF dividends keep paying regardless. The drip keeps running, and the foundation doesn't care what happened in the options account. And that's why this layered approach makes so much sense because you build the floor first, then you build higher. So here's where everything stands this week. We're going to go to our positions here. And we're still at the same ETF positions here. We got JEPI, XPay, SPYI. They're all active with drip running. We also got options enabled on this account. I still haven't used the checkbook, but I got it, and the margin mechanic is working in real life. So that's what's most important at this point. Not just the theory, but the fact that this is actually working and this is a real thing. Now, last week, I did mention that I'm building an income and expense tracker and portfolio manager designed specifically for people running this kind of strategy. So that's gig workers, 1099 contractors, income investors, and people with irregular income who need to see everything in one place. Small update on that. So, the reason that this exists is exactly what's happening on this episode. So, I paid my mortgage from the brokerage account this week. Now running options trades starting Monday. If the opportunity presents itself, I don't just trade every day. I trade when the market presents itself. Yeah, I'm tracking ETF dividends, margin balances, weekly income deposits, bill payments, all of this stuff, all in the same account. And right now, I'm doing all of that manually, just with notes, apps, screenshots, and mental math. And this is very draining. Talk about adulting. So this app is going to solve that. The percentage based allocation engine will tell you exactly how much of each deposit to invest based on the rules that you set. So the drip projection tool will show you what your dividend income looks like 6 months, 12 months, 3 years out based on your current positions and contribution rate. The expense tracker will show you how much of your monthly obligations the portfolio can currently cover via margin and what milestone you need to hit for it to cover them through dividends alone. And it's being built for this strategy and for my audience. So when it launches, you'll be the first to know. So more on that next week. This is a quick one today. That's pretty much week 6. The strategy is clicking. The mental model is very clear. And the portfolio, I guess you could say, is holding its value. I mean, I'm down like 3% total over here. Today's loss and gain was $7. Well, today is also Saturday night as I'm recording this. It's been a pretty busy week. I've been doing a lot of stuff in my personal life and in the business. But yeah, the margin is going to cover life, and the income will replace the margin, and the dividends will continue to grow that base, and we repeat. And that's it. That's the whole thing. So next week, I'm going to show you a fully functioning tool to help track your income and expenses and budget accordingly when implementing this strategy. So that's next Friday. So subscribe if you haven't, drop a comment, and tell me, have you ever paid a major bill from an investment account? Tell me what that felt like, because this week I know the answer to that. Investor forever. Let's build.